Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 16th, 2014. In this video, I wanted to do a follow-up to the static post. I made some comments on gold in the gold mining sector yesterday, and just wanted to do a quick follow-up, take a look at a few charts, and expand a little bit on my thoughts. This is the static daily chart for gold. I had posted that yesterday, and again, what I'm watching is this, I'm noticing the positive divergence that has formed here on this consolidation. I talked a little bit about this failed breakout at the time, somewhat of a bull trap. Pretty much, I had commented how extended. If you look at the run off the December, late December, mid December lows, we had such an extended run. You can see down here the RSI became very overbought. So the gold stocks were overbought and in need of a breather. And from my experience, breakouts that occur when prices are extremely extended like this rarely stick. What you want to see is consolidation and have those overbought conditions worked off, and that is exactly what's happened. So for those of you who followed the trades, I've remained, I short gold was one of the longest standing shorts on the site way back here off the highs, and I started becoming bullish, longer term bullish. We've had trades in between, long and short on gold and the gold mining stocks, but for the most part, gold hit my final downside target here in late December, early January, somewhere around there, and at this point, I remain longer term bullish on gold, and I think this action over the last few months, as frustrating as it may be to those that have continued to hold the stocks, some mining stocks and gold, you have to just take this from a longer term perspective. And right now, I mentioned the positive divergence setting up, the consolidation that we've had to work off this extreme, the overbought conditions from that run up earlier in the year. And I'm watching this downtrend line. This primary downtrend line goes all the way back to the highs back in mid to late 2012. So break above that uptrend line would be a bullish event. And as I stated, I think the next solid and sustained break, and what I mean by that, if you're a longer term trader, you might not want to jump the gun on a daily or an intraday break. You may want to wait to see a weekly close, even a follow up close above that trend line. If you're more aggressive, you can certainly take the intraday or daily breakout, maybe a partial position and add. Again, there's numerous trading styles. Even myself personally, sometimes I'm an active short-term trader, day trades, shorter-term swing trades. But I also have long-term accounts, IRAs, educational accounts for my kids' college. And in those accounts, I will position longer term. And right now I have been accumulating and holding some gold positions, but for the most part, I'm keeping that light because I want to see a breakout here of gold. Now, I'll talk on the gold mining stocks next, but as most of you know, the miners, for the most part, are just like a leveraged play on gold. Gold mining companies, they have their fixed costs. They have the fuel to put into their trucks and equipment, salaries they pay, rents or leases, all of those costs are fixed. So when the price of gold goes up or down, it is, has a huge impact on their earnings. If the price of gold were to rise 50%, that 50% gain, once they cover their basic costs to pull it out of the ground, that's just pure profit because their fixed or their variable costs, for the most part, hold constant. So, when you're trading gold stocks, you'd be remiss not to follow the chart of gold. What I mean by that, there's a triangle forming right now in the GDX. Let's say we get an upside break of that triangle. Well, that in itself would look bullish, but if gold is still below this primary downtrend line and gold doesn't break out and turns back down, then the breakout in GDX is likely to fail. So I always trade the miners. They're my preference, my go-to, because of the fact that they are more like a leverage play on gold. If you get it right, your gains are going to be a whole lot higher on individual gold mining stocks, especially if you can pick the most attractive looking charts out of the gold mining sector. That's what I aim to do when going long. and vice versa when going short. Look at the most bearish charts, and from my experience, the gains on those trades are often, you know, many times or quite a bit more than just trading GDX alone. Of course, there are people out there, or whether you work a full-time job elsewhere, you're more inexperienced in trading, there is less risk in trading an ETF because of the diversification. You're not going to wake up to a 20% gap down against a long position on some bad news on the GDX, but that can and will happen in individual miners. So with that being said, let's move on and take a look at some other charts here. This is the GLD. I haven't had time to clean up a lot of these charts. I'm just going to run through these quickly and again share my thoughts. So the GLD, just like gold, we were looking at spot gold prices a minute ago. You have this downtrend line, and again, we need to see a break over up and above this trend line. But so far, the bigger picture, the longer term picture remains bullish. We've had this double bottom. We had the lows back in July, and another low almost equal, slightly higher in believe it happened in late December on spot gold. Maybe it looks like early January. Okay, December 31st on GLD. Now, prices, there's a myriad of possibilities here. I do acknowledge that. I can't talk on every single possibility. Some people are calling for a triple bottom in gold. Some people are calling for a new low. Whether it happens or not, all I can do is try to keep my analysis as streamlined as possible. And right now, as I've maintained, for months, a longer-term picture, even what I've seen recently, looks bullish for gold. So I'm on the lookout for a breakout above this trend line, in which case I will start getting a little more aggressive on adding long exposure to either gold and or the mining stocks. So let's take a look at some of those. I'll go through these in no particular order. I have quite a few of these stocks flagged that I follow and I watch. Again, these charts have not been cleaned up for this video. A lot of these are old annotations from old trades back in June. You might recall I was lucky enough to nail the bottom on an entry for the gold stocks to the very day, actually within a couple hours of when GDX bottomed, and traded a lot of those stocks up and had a nice trade and exited. Well, we'd have to look at the GDX chart. This one hit the first target, never made it to the other targets, but I believe I posted closing out all my gold positions right around the time KGC hit that first target there. So what we're looking at here, at the time we had positive divergence. You can tell by these lines here. We're looking at the MACD, the RSI. We had a divergent low here, and that played out for a very nice move. Now, it may not look like much on this chart, but if we take a look at this on the lower or the upper left-hand side of this chart, you can see the gains. That was about a 37% gain from the lows there just to that first target. So again, there's such a large move on these charts. I'm using a log scale setting, and so it may not look like much, but again, 36% in just a matter of couple months. And since then, gold stocks took another leg down, but we still have at this point positive divergence in place. Prices are making a lower low from this June bottom. And the MACD, the RSI, you can pull up most indicators and price oscillators that you want to. You'll see the same thing. So we have positive divergence. Let's take a look and see if there's anything on the weekly chart. Okay, same story on the weekly chart. I prefer to use the PPO, which is very similar to the MACD. It just works better on longer term price movements, especially stocks with large price swings. So we have strong divergence in place, or at least forming here. I'd like to see the PPO curl up, make a bullish crossover. I don't know how well you can see this on the video, but once we have the bullish crossover there, that is then what I call confirmed divergence. Right now it's potential divergence setting up. RSI, we also have the positive divergence in place. So this is just a large bullish falling wedge pattern. Sometimes we'll see a final capitulation move where stocks will drop out, fall below the wedge, and then usually we're looking at a weekly time frame here, usually within a week or two, shoot back in the wedge and then break to the upside. So All in all, a bullish formation. We're still in a downtrend. The stock is still trading, off multi-year or all-time lows here. But again, setting up bullishly. And let's go ahead and move on to the next one. We'll stay on the weekly time frame. AU, don't see a lot. This was a key, reaction low back in late 2008. We broke below that level, which was obviously bearish. There was a considerable move, went from about 13.5 down to almost $11. But we've regained that level, and there's a good chance that AU has seen its lows. This is a daily chart. Again, what we're looking at here, positive divergence. Here's the MACD, the RSI, and although it's not drawn here, you can pretty much see the divergence is price is making a lower low against the MACD and RSI making higher highs, and that divergence played out for quite a move. I can't recall if AU was one of the top picks that I posted in late December, early January. But if so, it went up. The charts we're looking at here, I'm using my TC2000 charting program. A lot of the recent gold mining stock trades were on stock charts. This program is much more user-friendly, especially for doing these videos, easier to mock up charts, use trend lines, annotations, and hence I'm using this. But you can see here, there was a gap. I had this horizontal resistance line at. Nice gap there with some reactions below it, and that's where prices stopped and have pulled back and consolidated. And if you look, there's really support, not well defined, but there is support below this level. Actually comes in pretty well there. Let's see where that level is. 16. We'll call it 1650. Okay, so a lot of these stocks, my point is they've consolidated and they've pulled back to support levels. A lot of these support levels are my first target levels as well on a lot of the trades. Let's go ahead and move on. GFI, these orange lines show, a nice downtrend line, positive divergence in place, et cetera, et cetera, et cetera. And these stocks went up, and as you can see, their technical analysis has been working very well on the gold stocks. I say that because in the last few years, there's been a lot of gripe from traders about the distortion in the financial markets with the Fed and the high frequency traders really working against the retail traders and those using technical analysis. And I have seen that. Trading in the last few years has been at times more difficult than it was in the past before the bear market in 07, 08. At least that's been my experience. But for the most part, you can see a lot of these stocks, they have very well defined. You see a gap here with a lot of reaction highs. That was a solid resistance level. So when we broke out of this falling wedge pattern, prices moved up, tagged that level, pulled back, tagged that level again. And what we're doing here, we're making higher highs and also working off those overbought conditions. So on a stock like GFI, the next solid move, you'd want to take that reaction high to be safe. So I'd move that trend line up just a bit there. Try to line it up with that reaction high. So to be safe, say a move over 440. This is 438 right there where I place that line. And then, again, this chart has not been mocked up for my new set of targets, nor is this an official trade. I'm not going through my favorite trades. I'm just randomly going through some of the stocks that I've followed in the past and that I have marked up on. AKG, let's see if there's anything here. This is a weekly chart. This is an old notation that I had here when I think I shorted this one a couple times or at least once on the way down and made a note that the volume at price histogram, that this was a key support level and that if prices broke below that level, which they ultimately did back here, that it would be very bearish. Again, doesn't look like a whole lot, but we're looking at a move from about $2.75 all the way down to $1.50. So that stock dropped, almost in half, was almost chopped in half once it broke below that level. Tried at one point, 1 week, it was able to regain that level, but then quickly fell back. Now, bigger picture is the fact we are setting up, as you can see there, it looks like a large falling wedge pattern. We have divergences in place on the RSI, the MACD. Again, we're viewing a weekly chart. So longer term, when we finally take out this uptrend line, or I'm sorry, this downtrend line, there's a good chance that stock is going, at the very least, will come back and retest that horizontal line here, and I think ultimately go higher. This is Harmony Gold, HMY. Nice downtrend line, bullish falling wedge pattern. We're looking at a daily chart here. Positive divergences in place, at least there on the MACD. The RSI actually made a slightly lower low, so that's not really divergence there. But you did have strong divergence on the MACD, and prices ran up, hit this, right around this reaction high. This is a very nice resistance level and almost a magnet, in my opinion, if and when prices take out this reaction high here around looks like the 380-ish level. Let's take a look at the weekly chart. This to me is a very bullish weekly chart. This was a former support level that I had made mention of a few months back. How prices would, they'd be bearish if it broke down. Well, it did. If you look here, let's zoom in on that chart. Well, first, let's just take a look at what defines this level. We have this reaction low here, these reaction lows here, and then at the time we had, we had found support on that level, and that's when I noted this zone. Now, let's zoom in a bit, and you can see prices fell to the bottom of that support zone, made a nice gap below, and this has been the action since. Now we're seeing in place, when we made this recent low back in, looks like the beginning of the year, we had strong positive divergence in place. Positive divergence is defined by prices making this lower low here. Let's delete that line. So if you take that line I just drew against these up-sloping trend lines on the PPO and the RSI, that is the positive divergence. So that is bullish event number one. Bullish event number two, this is a potential inverse head and shoulders bottoming pattern. You have a left shoulder here, a down-sloping neckline, which is very common on the head and shoulders patterns. You can have up-sloping or down-sloping lines. And right now, we may be in the in the final stages of putting in a right shoulder. Now, of course, that is only a potential pattern at this point. We need to see prices move up here. Let's see. Okay, let's see if I can draw this out. So we'd need to see prices, to keep the symmetry in place. We could possibly go a little bit lower. We could move up now. So that would put in the right shoulder. You'd probably see somewhat of a reaction there on that trend line first, maybe a little bit of a pullback, and then boom, a breakout. Now, what I find interesting is when you take a look at these patterns, so often you'll take the measurement, the projection on a head and shoulders pattern. You just simply take the distance from the head to the neckline of the pattern. And well, let's see, I did this wrong. I can't move that line. Hold on one second. Okay, I need to use trend line on the chart so I can drag it. Okay, so you simply take the distance from the head to the neckline and add that to the point where the pattern breaks out. Now, just looking at a visual here, if prices were to reverse soon and put in this right shoulder, the breakout would happen somewhere around here. And as you can see, this pattern would project, assuming a breakout around, and this would be in the end of June, early July, that would project right to the top of that resistance zone. And I can't tell you how many times I'll take a look at a pattern, whether it's a head and shoulders, a rising or falling wedge pattern, take the projected measurement in it. It almost comes out to a key level, whether it's a Fibonacci retracement level, whether it's a horizontal resistance support or another key trend line. And so that's the case on HMY. So you have this head and shoulders pattern. Not to mention, since prices broke that support level, let's try to get a measurement here. From here to here, that is, what is that? 150%. No. Yeah, that's 150% move. So I would say that is a pretty healthy correction since that key support level was broken. And unless HMI is going to go away, which I doubt, I think that correction is more than enough based on the scope of this pattern here. NEM, this is Newmont Mining. Newmont's a big miner. They've been around forever. This is One that I'm holding on to now. I've liked the action on this. You had a nice, well-defined downtrend line, rising wedge pattern, divergences in place. We're looking at a daily chart here, breakout, which I believe I pointed out, and the back test, successful back test, and prices have moved higher. And let's take a look at the weekly chart. Here's a weekly chart going. This is a 10-year period, and you see these 1, 2, 3 candlestick tags of this support level here, and that was a key level. And as you can see here, that's where Newmont found support on this drop. Very, very oversold. And so far, ever since tagging that level, it looks like we only traded around it for a couple weeks, and prices have moved up. Like everything else, it's not drawn here. I can add that positive divergence in place. So I can go down the line. Most of the charts look this way. And again, the gold stocks are going to do what gold does. There are times where there's a little bit of a somewhat of a disconnect, but it's rare. For the most part, if you take a long-term chart of gold and GDX, put those on top of each other, you'll see the correlation is there. You're just getting more upside when gold is moving up with the gold stocks and more downside when gold falls. So as I always say, make sure you adjust your position sizing for the extreme volatility in the mining stocks. I like to use, larger stops because I'm accounting for much larger profit targets on a lot of these gold trades. We hit these for, well into the double-digit gains. We had some of these trades recently off the January, December lows that we closed out for, 40, 50, even 60%. And let's just wrap up with this one. One last example. This is one of the trades that was one of my top picks earlier this year into the end of December. And keep in mind, this is on a live link to this chart as well as most of those other stocks remains on the live charts page. I have yet to update a lot of these miners. I've been watching gold consolidates. I haven't been very interested, not posting, not doing a whole lot there. However, I do plan to comb through these charts and update a lot of the charts, add some price targets, pick some of my favorites, and I'll post those as soon as possible. This is the live chart from TRX, the weekly chart. And again, what we're looking at here, this chart, we're going all the way back to 2005, and we look at how well defined this support level is. There's 1, 2, 3 almost equally spaced tags of that support level. That was pointed out at the time. TRX was one of my top picks. You see this divergence here in place as we came down to that support level again. And let's flip over to the daily chart and just take a look at this. This will give sort of an example of some of my thoughts right now on these stocks. So what we had here, this was TRX. These are the notes. You can take a look at these notes. But essentially what happened is TRX broke above this channel in early 2014, ran up, hit the first target, pulled back, went a little higher, pulled back, came up, hit the second target for a 40.5% gain. Pulled back, went a little bit higher, but has since come back and consolidated. And look at the action around this former T1 level. Remember, resistance once broken becomes support. And I'm seeing that with a lot of these gold mining stocks, that they have now pulled back to their first or second target levels, and or some other support level. Look for gaps. Look for a lot of reactions around a certain level. Maybe a trend line, as I pointed out on that Newmont mining a second ago, how it came back and back tested the downtrend line. So depending on your trading style, some people might want to take stocks like this. For example, TRX, which still looks very healthy from a longer term perspective. This is an objective area to add. You could add right around current levels. Looks like it's just over $2 a share. A stop, I think, would be just somewhat below these recent reaction lows. I'd have to zoom in on that and tell you what that is, or you could take a look at your chart. So minimal downside, and if it does play out, I'll again have to update these charts, but the next target would probably be somewhere up around this reaction, this previous reaction high, which is almost looks like about 290 or so. And again, the more conservative entry for those of you who want more of a confirmed buy signal is wait for a breakout in gold, and then more than likely the gold mining stocks are going to follow very shortly after. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.